We shall commence this module by understanding the concept of investment. Investment, in simple words, is the purchase of stocks, bonds, plant, machinery, building, etc. The investment which does not generate any output and is a mere transfer of ownership is called the financial investment. Therefore, financial investment in shares is not included in the economic definition of investment. The real investment, on the other hand, adds to the capital stock and creates a productive capacity. It leads to an increase in the level of income, employment and production by raising the stock of goods. Apart from the financial and the real investment, there are other bases also to distinguish between the different types of investment. The level of investment in the economy is very sensitive to the changes in the prevailing interest rates. Generally, when interest rates are high, investments decreases and vice versa. The Keynesian theory of investment gives importance to the role of interest rates in investment decisions. Changes in the interest rates affect the level of planned investment undertaken in the economy. A fall in the interest rates decreases the cost of investment relative to the potential yield, and as a result, planned capital investment projects on the margin becomes worthwhile and investment rises. A firm will only invest if the discounted yield exceeds the cost of the project. The inverse relationship between the investment and the rate of interest is represented by the marginal efficiency of capital investment curve, which is known as MEC curve. Not just the rate of interest, but other factors also affect the expected profitability of an investment project, like expectations, cost, technical changes, etc. After studying this module, you shall be able to know the meaning of investment, know the various types of investment, identify the determinants of investment, evaluate the meaning and determinants of MEC, analyze the relation between MEC and rate of interest. Let us now analyze in detail the meaning, different types and determinants of investment spending. Investment is an increase in the capital stock, such as buying a factory or machine, or in simple words, it is the addition to the productive capacity. The decision of the firms and individuals about how much investment to make depends on the interest rates and marginal efficiency of capital. If interest rates are high, then it makes it expensive to borrow money and leads to a fall in investment. This is because investment is often financed through borrowings. Also, when interest rates are high, it becomes more attractive to save money. Investment is often financed out of retained profit. Thus, high interest rate means that saving money in a bank is more attractive than investment. Marginal efficiency of capital, in simple words, is the expected profit rate from investment. The investment decision is a marginal benefit, marginal cost decision, where the marginal cost is the interest rate. First, that must be paid for the borrowed funds, and the marginal benefit derived from the investment is the expected rate of return, known as R. Any investment decision will be made by comparing these cost and benefit. An investment is made if the expected rate of return exceeds the interest rate, that is R is greater than I. Investments are not made when interest rates exceed the expected rate of return, that is when R is less than I. When the marginal benefit is exactly equals to the marginal cost, then this will be an individual's decision to invest or not according to his need. Investment is inversely related to the interest rate as shown by the downward sloping investment curve, any change in the interest rate will lead to a movement along the investment curve, raising or lowering it. If there is a change in any other factor apart from the interest rate, like the changes in the cost, expectations, technology, etc., then this will lead to a shift in the investment demand curve. Next, we will discuss the types of investment. There are many bases on which investments can be distinguished. Firstly, planned investment and unplanned investment. The planned or intended or voluntary investment is undertaken by a firm in order to achieve certain predefined targets. It leads to an increase in the existing stock of capital through addition to the inventories or installation of an additional machine. This type of investment may be motivated by larger sales or by favorable market conditions. The unplanned or unintended or involuntary investment, on the other hand, is that part of investment which is not anticipated or intended by the firm. It takes place when the planning does not go well with the real world situations. When the unplanned investment is equals to 0, the realized investment will be equal to the planned investment. But the actual or the realized investment may not be equal to the planned investment. So, the realized investment is equals to the sum of planned and unplanned investment. Therefore, actual investment is equals to planned investment plus unplanned investment. Secondly, financial investment and real investment. The financial investment can be in the form of deposits into the bank, purchase of existing shares, debentures, bonds in the secondary market, etc. All such investments lead to the transfer of ownership rights from one person to another person and do not create anything new. It does not add to the real capital stock in the economy. From the economy's point of view, there is no investment as these leave the stock of economy's real capital unchanged. The real investment, on the other hand, leads to the creation of additional productive capacity in the economy. The examples of real investment include establishment of a new factory on a workshop, acquisition of a new plant and machinery, purchase of a new building for official or personal use, etc. Real investment has significance for the economy also, as this raises the capital stock and in turn the income. It is important to note here that when individual purchases new shares of a company, this financial investment will represent the real investment because that would create a new capital asset. Thirdly, gross investment and net investment. The gross investment is whatever additions are made to the capital stock of the economy. This can take the form of expenditures on new fixed capital assets, for example, houses, machinery, factories, etc., or change in the inventories over a given period of time. However, a part of the new capital is used to replace the depreciated capital goods. So, the gross investment is not the net addition to the capital stock. The expenditure that a firm incurs to replace the depreciated capital during the year is called the replacement investment. The net investment is thus obtained after deducting this replacement investment from the gross investment. Therefore, we can say that net investment is equals to gross investment minus replacement investment, or gross investment is equals to net investment plus replacement investment. Lastly, autonomous investment and induced investment. This classification of investment is based on the determinants of investment. The investment is said to be autonomous if the amount of investment is unaffected by the level of income or the market rate of interest. This investment depends upon certain socio-economic and political factors. On the other hand, investment that depends upon the profit or income expectations of the entrepreneurs is called the induced investment. There can be many factors like prices, wages and interest changes which affect the profits and thereby induce the investment level in the economy. An increase in the level of income causes an increase in the level of employment and thus an increased demand for the consumer goods. This in turn leads to an increase in investment. While the investment is inversely related to the rate of interest, this is because interest rate is the cost of investment. Higher the interest rate discourages the investment. Next, we will learn the determinants of investment. Investment and production decisions are taken up by the firms by considering their profitability. These decisions are influenced by the expectations that the entrepreneurs form about the future revenue and cost streams, which allow them to make guesses about what their profits might be. Investment decisions thus depend on whether the productive asset being purchased delivers a positive return above the cost or not. There are two main determinants which influence the decision of a firm or individual to invest in a new project. First, the market rate of interest. Whenever an entrepreneur decides to invest in a capital good, he either borrows funds from the market for which he has to pay the market rate of interest, or he uses his own resources to finance the investment for which he sacrifices the interest rate which he could have earned on by lending his funds. So, the rate of interest is the price of investment. A higher price in the form of high interest rate will discourage investment. Second is the marginal efficiency of capital. The marginal efficiency of capital is a technical ratio which tells by how much investing in capital increases the output. It can also be considered as the expected rate of return on capital investment. Specifically, it refers to the annual percentage yield earned by the last additional unit of capital. The investment decisions are based on the comparison of MEC with the market rate of interest. If the MEC, that is marginal efficiency of capital, was 5% and rate of interest were 3%, then it is worth borrowing at 3% to get an expected increase in output of 5%. However, if the marginal efficiency of capital is less than the interest rate, then it is not worthwhile investing. Marginal efficiency of capital is in turn determined by two factors. First is the supply price of the capital asset. The supply price of an asset is the price at which a capital asset is acquired. This purchase price of the asset is called as supply price or the replacement cost by Keynes. At this price, new capital asset is supplied or purchased. Second, prospective yield of the investment or capital asset. Prospective yield is the expected flow of income from the investment during its lifetime. It is calculated by deducting the supply price of the capital asset from the expected income from the use of the asset during its working lifetime. Whenever a capital asset is purchased, its total working life and its return remains uncertain. Therefore, the entrepreneur has to make a careful estimate of the expected life of capital asset as well as the flow of income during his lifetime. As the capital asset is expected to be used for a number of years, its annual return in each period is added to get the return during its economic life. This annual net return expected from an asset is termed as annuity. Present value of these annuities is obtained by discounting each annuity for a number of years it is expected to be used from the present. The discount rate used is the expected yield from the asset and it is calculated by doing compound interest calculations in reverse. So, prospective yield is a series of annuities, let us say Q1, Q2 till Qn. These are the future flows of cash associated with an investment which the entrepreneur expects to obtain from selling its output. The current value of a future cash flow is called its present value, which is denoted as PV. The general formula for the present value of a cash flow to be received at the end of period n is PT is equals to PT plus n divided by 1 plus I to the power n, where PT can be thought of as the purchase price, PT plus n can be considered as the net future yield on the asset n years from now, and I is the rate of discount or yield rate. In the situation where the expected cash flow of varying size are distributed across several different time periods, the present value of a flow at time t, PT, can be written as PT is equals to PT plus 1 divided by 1 plus I plus PT plus 2 divided by 1 plus I to the power 2 plus PT plus 3 divided by 1 plus I to the power 3 plus so on till PT plus n divided by 1 plus I to the power n. In this equation, PT is the total discounted present value of the future streams of incomes expected from investment in the capital goods during its lifetime. The term on the right hand side of the equation represents the present value of the expected income flow expected at the end of each year. Firms are faced with different investment options with different revenues and cost outlays profiles over time. So, a firm should undertake an investment project only if the cost of a capital asset is less than the total present value of the prospective yield. If the cost of the asset exceeds the present value of the yield, then it is worthless to undertake such kind of investment. Further, we will discuss the marginal efficiency of capital known as MEC. Keynes defined the marginal efficiency of capital as being equals to the rate of discount which would make the present value of the series of annuities given by the returns expected from the capital asset during its life just equals to its supply price. The rate of discount he was referring to is also known as the internal rate of return of a project. The internal rate of return is the interest rate that would discount future income and cost outlays such that the net present value was 0. We can calculate the present value of a capital asset by discounting the value of its future flows. The net present value is the present value of the revenue to be received minus the present value of the cost of the capital investment. A positive net present value implies that the investment earns a positive rate of return, while a negative present value means that the investment is worthless. Consider the investment on an equipment which is expected to be used for next 5 years. In the current year, the firm has to spend $10,000 to purchase the equipment. In subsequent years, it receives the cash flows of $2,500, $3,200, $3,500, $3,300, $2,400 respectively. If there is no scrap value for the equipment after 5 years, what will be the internal rate of return of this investment? The present value of the cost is $10,000 incurred in the current year. If we add up the cash flow in each of these years, the dollar sum of the cash return turns out to be $15,000. But the dollar amount cannot be compared across time periods because the impact of compounding the present value of the flow of revenue is given by PV is equals to $2,500 divided by 1 plus I plus $3,200 divided by 1 plus I to the power 2 plus $3,500 divided by 1 plus I to the power 3 plus $3,300 divided by 1 plus R to the power 4 plus $2,400 divided by 1 plus I to the power 5. Now the internal rate of return is the discount rate, that is I, that satisfies the following equation. NPV is equals to $2,500 divided by 1 plus I plus $3,200 divided by 1 plus I to the power 2 plus $3,500 divided by 1 plus I to the power 3 plus $3,300 divided by 1 plus I to the power 4 plus $2,400 divided by 1 plus I to the power 5 minus $10,000 is equals to 0. Mathematically solving the above equation, we calculated the IRR at 15.1%. This investment will be profitable if the cost of borrowing funds to fund the project, that is the market rate of interest, is below the IRR. Internal rate of return is basically known as IRR. Now, internal rate of return is nothing but the marginal efficiency of capital that we compare with the market rate of interest to decide the viability and profitability of any investment project. The market rate of interest remains almost stable, but MEC is violating. Now, firms seek to invest in those projects which yield higher MEC. MEC schedule relates MEC to the alternative level of investment of a firm. Suppose there are 3 investment projects A, B and C available with the firm with different MEC. Now, project A has an IRR or MEC of 10%, while project B has the MEC of 8% and project C has the MEC of 5%. Now, the firm must consider how much new capital expenditure it will incur for the coming years on the basis of the profitability of each investment project. If the market rate of interest is currently 9%, then the firm would only be interested in investing in project A, which means that its capital expenditure in the current planning period will be limited to project A. if the market interest rate drops to below 8%, then it would be profitable to borrow sufficient funds or use retained earnings and invest in both project A and project B. As a consequence, the total investment will rise. The firm will expand the investment to project C only if the market rate of interest drops below 5%. The downward sloping MEC curve indicating the inverse relationship between investment and MEC. There is an inverse relation between MEC and investment because A. More investment leads to higher output, and this will intensify the competition among the producers, driving down the prices. Now, as the prices will fall, prospective yield from the capital assets will decline. B. Increase in investment raises the price of capital assets. This means that the supply price of capital assets rises and consequently MEC falls. Let us now learn about the shift in the marginal efficiency of capital. Any change in MEC leads to a movement along the MEC curve, but we should also consider the crucial role of the expectations and other factors firms might consider when forming the expectations of the future returns. If the planned investment changes at a given rate of interest, this causes a shift in the MEC curve. For example, a rise in the expected rate of return on an investment project would cause an outward and rightward shift in the marginal efficiency capital curve. Conversely, if pessimism prevails, a fall in the business confidence would cause a fall in the expected rate of return on capital investment project, and thus the MEC curve will shift to the left and will cause a fall in the planned investment at each rate of interest. Further, we will learn about MEC and rate of interest. The simple investment model, which says that higher market rate of interest leads to lower total investment, is based on the assumption that all other things are equal. But MEC plays an important role in determining the investment. It is based on the comparison between the demand side and the supply side. The demand sides are basically the expected revenues and the supply sides are the replacement cost. Now, in a growing economy, the analysis of investment only on the basis of interest rate could be misleading. It is possible that at time aggregate demand conditions are improving even when the market rate of interest rises. The increased aggregate demand will improve the revenue cash flows over time and increase the MEC for each project. This implies that investment will not fall even when the market rate of interest is high because the IRR or MEC of each project is increasing. Thus, investment would not be very responsive to the changes in the market rate of interest, especially when the economy was in recession or boom. This is because expectations formed by the entrepreneurs affect their MEC calculations. When the economy is in recession, entrepreneurs would become pessimistic and this would negatively impact their assessment of the future returns from the different projects. Even with substantial excess productive capacity, firms are unlikely to expand the capital stock even if new investment projects become cheaper as the central bank cuts the market interest rate to stimulate demand. The extreme optimism that typically accompanies a boom would also reduce the sensitivity of investment to the changes in the market rate of interest. With high expected return, firms will be prepared to pay high borrowing cost. Optimism can be shown by a rightward shift of MEC curve, which would raise the investment at a given market rate of interest. Further, if entrepreneurs became excessively pessimist, then the MEC curve would shift leftward and fewer investment projects would be deemed profitable at a given market rate of interest, even if the technical aspect of the equipment was unchanged. This implies that investment is a very subjective act and responsive to how firms felt about the economy. In short, the profitability of any investment project is assessed by comparing its MEC with the market rate of interest. If MEC is higher than R, then only any investment will be made. Let us now summarize what we have learned in this module. First, investment is an act of addition to the productive capacity of a firm. Second, the investment decisions are based on the marginal benefit, marginal cost analysis, where the marginal cost is the interest rate and the marginal benefit is the MEC, that is marginal efficiency of capital. Third, investment can be classified in many ways like gross or net investment, real and financial investment, autonomous and induced investment, etc. Fourth, marginal efficiency of capital is that rate of discount which makes the present value of the series of annuity given by the returns expected from the capital asset during its life just equals to its supply price. Fifth, any investment project is considered profitable only when its MEC is higher than the prevailing market rate of interest.